Good morning, everyone. I hope you are doing good and fine. So today in this video, we'll be discussing the chapter known as FI, revision of FI financial instrument, three standards, IAS 32, IFRS 7 and IFRS 9. So starting with the revision of financial instrument 3, 2, 1. Financial instrument. This topic has three standards: IAS 32, IFRS 7, IFRS 9. So IAS 32 will discuss regarding what? Classification and presentation of FI. IFRS 9 will deal with how it is measured and where and when they should be recognized. Recognition and measurement part is covered in IFRS 9. Then IFRS 7 deals with the disclosure of financial statement in the financial disclosure of financial statement in the financial instruments in the financial statement. Then we had discussed the meaning. Meaning was what? So financial instrument means a contract which creates financial asset for one entity. For the other entity, it could be a financial liability or a equity instrument of another entity. Then we discussed there are two types of instrument: primary instrument, derivative instrument. Primary instruments are covered in your FR, derivatives are not tested in your FR. Then we started a discussion regarding financial instrument. Financial instrument means what? Cash, contractual right to receive cash or another financial asset from another entity. Then equity instrument of another entity. If you have done any investment in any other company, that is also considered. Then contractual right to exchange financial asset under potential favorable condition. We had taken the examples of options, swaps, not tested. The accounting will not be tested, but you should have an idea that this is also financial asset. Then certain contract which will or may be settled in the entity's own equity instrument. If the settlement is done in the entity's own equity instrument, then also it is a financial asset. Then we have discussed the statutory obligation will never create a financial instrument like your tax, etc. Then we had a discussion regarding, we had taken the example Raju, Ram, payable, a lot of things. Then we had took the example for preference shares. Redeemable is a liability, irredeemable is a equity. But you have to see whether dividend is compulsory or dividend is not compulsory. On that basis, we have to further decide it. Then we started the discussion regarding liability. Liability means contractual obligation to deliver cash or another financial asset to other entity. Then second one is what? Contractual obligation to exchange financial instrument with another entity under conditions that are potentially favorable. Unfavorable. Like we have seen for asset, it is favorable, here it is unfavorable. If you're doing a betting and it's not in your favor, then it is a liability because you have to pay someone in the future. Then certain contract that will or may be settled in the own equity instrument and it should be in variable number of shares. In own equity instrument, variable number of shares, then we say it is liability. Equity instrument means residual interest in the net asset of the entity. And contract to issue fixed number of shares, equity shares, is also a equity instrument. So with this we had covered the definition. Then we started the discussion regarding the examples. All this were the financial assets, financial liabilities, etc. Then investment in equity also is a financial asset. Then I mentioned inventory, PP, intangible assets. It's not a financial instrument. Then we discuss, these are the topics important for your MCQ. Advance given for goods or services or advance received for goods or services are not your financial instrument. We have done the detailed discussion in the class. Then gold also, it's not a financial instrument because it is not a liability or equity to someone. Gold bond, it will be. Then income tax refund or payable will not be a financial instrument. So with this, we had seen what are the examples of financial asset, financial liability, etc. Then we started a discussion regarding the classification. We had seen that is financial asset for one entity, financial liability or equity for the other entity. So under financial asset, what are the three methods we have? Under financial asset, we have three methods: amortization cost model, fair value through OCA, fair value through P&L. And amortization cost model, fair value through OCA, fair value through P&L are very important as per financial asset under debt instrument. But when coming to equity, we have fair value through OCA and fair value through P&L. In financial liability, we have two methods: amortization cost model and fair value through P&L. In equity, it will be recorded at the initial amount only. It will be recorded at the initial amount. I mentioned that an MCQ question could come saying that will you restate the equity every year? So investment in equity instrument is totally different and equity instrument is totally different. So understand that. So then we started our first discussion regarding financial liability. I mentioned if financial liability is clear, then your financial asset will be very easy. So in financial liability, we have how many methods are in financial liability? These were a lot of questions we had done in the class. Yes. So financial liability. Financial liability. When we will recognize financial liability, a financial liability is recognized only when an entity becomes a party to the contractual provision of the instrument. He becomes a party to the contract. Which contracts are financial instrument? And I mentioned in the FR exam, all financial liabilities will be subsequently measured at amortization cost method. But can we say fair value through P&L can come? Yes, it can come. You have to remember what is the basic points for theory question. So then we had started measurement, sir, and subsequent measurement. Measurement means initially at what value you will record. Initial measurement, subsequent measurement. Initial measurement, sir, we will record initially at fair value. So fair value, what did I mention? Fair value is your face value minus discount. Face value minus discount. So here, what should you keep in mind? Net proceeds. Net proceed received, because a company will be issuing bonds. They will be getting the amount. So net proceed received in the pocket. So issue proceed minus transaction cost, you will reduce this, and this you will record over the period based on amortization cost method. But if I say the company is following initially only fair value through P&L, then will what happen? If financial liability is classified as fair value through P&L, then transaction cost will directly go to P&L under financing category. Under financing category. Then amortization cost we have seen using EIR rate, we will record the finance cost in financing category. The interest will be paid on coupon rate, that is face value, nominal value, or par value of the financial liability. In fair value through P&L, sir, what we will do, difference, the fair value, opening and closing fair value will directly be recorded to financial category as an income or an expense based on whether gain is there or loss is there. Then this fair value through P&L will apply to short-term liabilities like your derivatives, etc. Then third point, finance cost will be recorded at coupon rate directly to P&L. So this is the most important part that could come in the MCQ. That finance cost will be recorded at coupon rate directly to the P&L under which category, sir? Financing category. That is face value into P&L, the income or expense. There are two income, the difference, and this is the second one. So we had seen the amortization table, opening balance, finance cost, sir, opening into EIR rate, financing category, payments of actual interest, face value into coupon rate, and closing balance. That is 2 plus 3 minus 4, you will get 5. And I mentioned EIR rate will include what, sir? EIR rate will include coupon rate, discount, transaction cost, and redemption premium. So these all are included because these all are recorded expense over the period. Over the period. So discount is also a form of interest on it. So discount which we get is form of interest on it. So that is the reason it is included EIR, and over the period we record expense. Transaction cost should also be spread over the term because the loan is giving benefit over the period or the financial liability. Because of which principle? Matching principle. Actual payment is paid on the face value by using the coupon rate. Actual payment is paid on the face value by using the coupon rate we have discussed. Then this was the basic example we had seen. A company issues bond with the following item. Face values $20,000, coupon rate is 4%, term is 5 years, EIR rate is 7%, transaction cost is the discount is this, and redemption premium is 10% of the face value paid at the end of the 5th year. So we had to calculate the fair value. Fair value how, sir? 20,000 minus the discount, 9,500. Then issue cost you will reduce. Issue cost will reduce. You will get the net proceed received. So what is the entry? Debit what comes in? Credit financial liability 19,500, 19,500. Debit bank and debit financial liability, credit bank, because the issue cost is going out here, and we have to record this at net proceeds. So either you can record both separate, or either you can combine these journal entry and record in your books. Then we had seen that in your single entity question, the examiner says that sometimes the issue cost is directly taken to administrative cost. That is wrong. We have to capitalize, we have to reduce from the liability so that it is recorded expense over the years. So thus we had seen. Then amortization table. Then the further amortization table, we had seen that this was the opening value, this is finance cost and payment, and this. Then we had seen every year what is the entry we passing combined. Debit finance cost, credit financial liability, debit financial liability and credit cash, it is reducing it. So this is the combined entry. And we had seen that this is the total expense which will be recording into the P&L. So once we do this total, it is coming the same answer. It's coming the same answer. So then with this, we have completed financial liabilities. So then we started a discussion regarding what, sir? We started a discussion regarding compound instrument. So compound instrument means what? I mentioned you, compound instrument means an instrument which has both characters of financial liability and equity. A financial instrument that has characteristics of both equity and liability, such as convertible loan. Convertible instruments are accounted using which method? Which accounting? Split accounting. You have to separate financial liability and you have to separate equity. Then we had seen this flow chart to understand whether it is equity or liability. Interest and dividend, if it is compulsory, mandatory, then financial liability. If it is at the discretion, at the choice of the company, then it is equity. If the borrowing is redeemable, financial liability. Irredeemable or perpetual, equity. If borrowing is convertible in variable number of equity shares, then financial liability. Fixed number of shares and it is compulsory to be converted, then you will record equity only. The principal amount we will not take at the end of the fifth year. If it is convertible at the option of issuer entity, they will always choose to account as equity. At the holder, then you will say that it is a compound financial instrument. Then cumulative preference dividend leads to a financial liability because dividend has to be paid every year. Non-cumulative preference dividend leads to equity for MCQ. This could be helpful for you. Then we had started a discussion regarding the steps for accounting. Step one was what? So step one was to identify financial liability and equity component. So we identified, how did we identify financial liability? So present value of the contractual cash flow. The cash flow which are there in future, you will discount that using which rate? You will discount that using market rate of interest for similar instrument without conversion option. Not conversion option, without conversion option. Then equity component, total proceeds minus financial liability, you get your answer. Step number 4, unwinding the financial liability. You should unwind normally, treat the liability as per the respective standard, that is financial instrument. Then note, financial liability is measured at amortization cost method and equity is measured at cost. So the value will remain same. So this is the thing which we have taken an example handle. And then I mentioned your transaction cost. In case of transaction cost of compound instrument, what should you do? You should allocate transaction cost to financial liability and equity component in the ratio of the above amount which we have calculated in step number 2, step number 3. Use that and allocate it. Then what will you do? Then deduct from the amount calculated above and record the initial value. So discount rate for unwinding will be the discount rate which you have used for discounting it. That is market rate without conversion option. And I mentioned this part is very important for your MCQ. Then journal entry, debit bank, credit financial liability, credit equity. Then sir, after 3 years or 5 years on maturity, what will happen? On maturity, either the shares will be converted, either the shareholders will say that we want equity shares, so we'll remove financial liability, we'll remove equity, and we'll record share capital, that is face value, into the number of shares, and credit share premium, that is the balance, remaining balance. If they say that they are need in cash, then debit financial liability, credit bank. So whatever is the financial liability, they will be recording it, debit financial liability, credit bank, because they are paying the amount. If it is 5 lakh rupees they are paying, then they will remove the equity and record where they will transfer to retained earnings. They will transfer to retained. So this was the basic example. 4% convertible bond at nominal value of 50,000. Each $1,000 of bond is converted into 400 equity share at the end of 3 years. Market rate is 6%. Present value is 4%, 6%. They will give you this to confuse you, but we have to take this discounting rate to discount the value. So see, cash flow we have taken 2,000. How? That is 50,000 into 4%, 2,000, 2,000, 2,000. And at the third year, you should take 50,000 also full. Then 6% we have taken discount and we have calculated the value. We got financial liability as 47,340 and the equity as 2,660. So this is the entry we have passed. Then amortization table we will follow for your financial liability. Equity will be recorded at the cost only. So opening balance, finance cost, and payment of actual interest, closing balance. Normally we have seen in financial liability. Same way you will be doing. So in P&L you will record finance cost. In P&L we will record finance cost. And in your balance sheet, what all will record? We will record your non-current liability and we will record your equity part. See here, equity option will be recorded at the same value, and financial liability at the third year it will be paid. So current liability will be recording. Then at the end of the third year, sir, redeemed in cash. If they are taking cash, credit cash, debit financial liability. Then debit equity, credit retained earning. We have seen this. It should be transferred. Then converted to equity share. And I say that how many $1,000 of bonds are converted to 400 shares. So totally 20,000 shares should be given. So debit financial liability you remove, debit equity also you remove. Share capital is how much? 20,000 shares into the face value is $1, 20,000, and remaining will go to the share premium. So with this, we have completed the revision of your compound instrument also. Then we had started a discussion regarding which one? Sir, we started a discussion regarding our financial asset. Under financial asset, what are the things we have seen? Under financial asset, when should we recognize? When a party becomes what? When a entity becomes a party to the contractual provision of the instrument, financial assets are of two types: debt instrument and equity instrument. Amortization cost method, fair value through OCA, fair value through P&L, fair value through OCA, fair value through P&L, based on these two things. Then under debt instruments, sir, how many methods we have, sir? Amortization cost method, fair value through OCA, fair value through P&L. That depends on two tests, BMT and CCCT. That is a contractual cash flow test and business model test. So now in amortization cost method and fair value through OCA, what is the basic point which is similar, which is same? That is intention to collect only the contractual cash flow, that is interest and principal in both the cases. But for amortization cost model, it is what investment must hold, entity must hold the investment till maturity. Till maturity, we had taken the example that if Raju gets an option to date a Bollywood actress, he will not choose. He is committed to his girlfriend. But when compared to fair value through OCA, he says that if I get a chance and I have a crush on that celebrity, I will try. So here what? Intention to hold the investment till maturity is there, but may sell the investment if better opportunity is available. If they are getting some higher returns in other projects, they will sell this and they will use it in the other investment. Then fair value through P&L, this is used for short term and the intention is to hold the asset for trading purpose. And here, if the contractual cash flow test is failed, then it is a convertible bond. In most cases, that is convertible bond, the CCT is failed. Then we had discussed the subsequent and initial and subsequent measurement of financial asset. So here we will record at fair value. Fair value means what? The net proceeds or net outflow of the proceeds, because you are investing. Here you will be incurring the transaction cost. So you will be adding the transaction cost. In financial liability, we were reducing it. Here we will add it. We will add it because the net outflow we are considering. Then we started a discussion regarding methods. Amortization cost model. Yes, sir. Initially recognition at fair value. Fair value means face value minus discount. Transaction cost, sir, it will be capitalized, add it. Why? We have to consider the fair value. Recognition of income based on EIR rate. Then subsequent measurement at amortized cost. Then income and interest, where it will be recorded, sir? Income or interest will be recorded in P&L. Under which category, sir? Investing category, because this is your investment. And then any gain or loss on disposal will be recorded to P&L. Which category? We have discussed this in derecognition part in detail there. So we'll revise that also. Then fair value through OCA, sir, we recorded fair value only, sir. Transaction cost is also capitalized, sir. Recognition of income is based on EIR, same amount as amortization cost at fair value. Whatever is the EIR rate which we have recorded under amortization cost will be the same. Then difference will go to OCA. Difference will go to OCA. Income in investing category, any gain or loss to OCA shall be transferred to P&L. So reclassification is allowed here. Here reclassification is allowed in debt instrument for fair value through OCA, but for fair value through OCA in equity instrument, reclassification is not allowed. A MCQ question could come. So I mentioned reclassification means what? From OCI it will be recorded, it will go to P&L and then to retained earnings. But if it is not reclassified, from OCI to directly to retained earnings. Then we discuss fair value. Fair value means, sir, at fair value it will be recorded. Transaction cost will not be capitalized, it will be transferred to P&L under investing category. Then recognition of income based on coupon rate, same we have seen in financial liability. Then subsequently measure at fair value, any difference will be transferred to P&L. Any difference will be transferred to P&L. Then incomes are investing category, any gain or loss on your disposal will be recorded to P&L. Here also any gain or loss will be recorded to the P&L, and then the remaining balance will be transferred to the P&L. So this was the discussion which we had regarding initial measurement. So we had seen a basic example, 10,000 bond at 6%, discount is 1,500 was the premium, issue cost was $144, and the effective interest rate was 11%. If A plans to hold the bond until the redemption date, then this is what amortization cost method. So fair value we have discussed, minus 1,000, 9,000 was the value we have got. 9,000 was the value which we have got. Then it was transaction cost we have added. So 9,144. What is the entry? Is a debit, finance asset, credit, cash 9,000. And then we are paying your transaction cost. We have to increase this. Then actual interest received is what? 10,000 into 6%. At the end of the third year, the amount that should be received is 10,000 plus 500 of premium. So 10,500 should be we should receive. Then amortization cost opening. This is your finance income, not a finance cost. So debit, finance asset, credit, finance, P&L as an income, and then the actual payment is done on coupon rate. You get your closing balance. So this is the way we have seen, and we have done the total also, that your income is tallying what all is your income. Only one thing was your expense, that is your transaction cost. So in interest income, financial asset. Then we have seen the second type. If A plans to sell the bond, if the possibility of an investment with a higher return arises, it will be shown under fair value through OCA. It will be shown under fair value through OCA. So this was the normal table which we had used for amortization cost model. For fair value through OCA, you should use the same. But what are the changes? Opening balance will remain same. Finance cost will remain same. Actual interest will be the same. These two things will remain same as per amortization cost method. Only what will change? Sir, the closing balance. The closing balance you got 9,550. Then gain or loss you will have, because you should record this at fair value. So fair value is 11,000. Whatever is the difference is 1,450 is your difference. Then second one is 11,000. Then you should take this balance 11,000 at the opening, but the finance cost will remain same. You will not apply finance cost on this 11%. It will be wrong. Then actual interest payment is done. Closing balance, we got this. Closing balance, for closing balance you will consider this. Then you have this as the value. So this is what, sir, we have a loss. So this loss will be recorded in OCI, and from OCI it will go to OC. Then next year take this as the opening, finance cost, actual interest same as your this one, and then closing balance, and whatever is the loss will be recorded in OCA. So this will be recorded in 3 years into P&L for financing category as an income. This will be recorded in cash flow as outflow, and OCA and balance sheet are, these are the values that will be shown in balance sheet. We have discussed a lot of questions regarding this one. Then we started a discussion regarding what? We started a discussion regarding, this is the way you present for financial asset, OCA. We have to present it finance income, investment income, and financial asset. Then third, if bond is held for trading purpose, fair value through P&L. I mentioned transaction cost as expense in P&L, change in fair value through P&L, interest income in P&L, nominal value into the coupon rate, nominal value into the coupon rate. So initial recognitions are fair value 9,000, you will record it. Debit financial asset, credit cash. Transaction cost directly into P&L, you will take it. You are paying this and directly you will take this into the P&L. Then interest income, sir. Interest income is based on the face value, nominal or par value into 6%, that is 600, you record as an income. Then on 31st December, if I say fair value is 11,000. So what is the value we have recorded initially? 9,000 minus 11,000. So 2,000 is a loss for you, because it is a gain to you, because can I say the value of the asset is going up. So in P&L, which category, sir? Investing category will be recording. Debit financial asset, credit financial value, fair value gain. Then we had seen what? Then we had seen an example for equity instrument. So for equity instrument, what are the two methods? The two methods which we had discussed. The first method was your fair value through P&L and fair value through OCA. So default method in both the cases is fair value through P&L only. But can the company choose fair value through OCA? Even though there is no contractual cash flow here, even though contractual cash flow is not there, only for fair value through P&L and fair value through OCA and amortization cost, we had seen above that we have contractual cash flow. Here we do not have contractual cash flow, even though we can use fair value through OCA. But if the company will elect today, they can't come back to what? Fair value through P&L back. So initially recognize that fair value, sir. Transaction cost for fair value through P&L, every time it will transfer to P&L only. It will not be capitalized. But fair value through OCA, you will capitalize it. Dividend income will be recorded in P&L, investing category. Subsequently measured, any fair value will go to P&L under investing category. Any difference will be taken to OCI. And this is for short term, this is for long term, fair value through OCI. Disposal, gain or loss is transferred to P&L investing category, and gain or loss is first when you sell any item, you should sell any equity under your financial asset and equity type. Then what should you do? You should first revalue them or remeasure them at fair value through OCA. Take that amount to OCA, and then whatever is the balance in OCA will be taken directly to retained earnings or left in equity, because it will not be reclassified. MCQ, very important question. So fair value through OCA is irrevocable option at the time of initial recognition. Once you choose it, you can't come back. So then we had seen a basic example regarding this. A purchased shares of Reliance for 1,800 on 1st Jan 2024. On 31st 12 2024, fair value of the Reliance is 1950. So transaction cost was 50. If default method is fair value through P&L, debit investment, credit this bank, then transaction cost you will record directly into the P&L. Then what you will do, sir? Then the difference was how much? 1,800 and 1,950. Difference is 150. The increase in value is that. So directly to P&L investing category. If fair value through OCA is selected, irrevocable option, then sir, debit this credit bank we have recorded. Transaction cost will be capitalized. So your value will become how much? 1850. And fair value is at what? 1950. Whatever is the difference, where will you record? The difference you will be recording in OCI. And now when the company is planning to sell, I mentioned you 2000. What should you do? This 50 first you should increase the investment value. First you should increase the investment value. Then debit bank credit investment in Reliance shares is going up. So total gain in OCI is how much? 100 plus this 50, 150. Not reclassifying to P&L. It will be classified to retained earnings, or within the equity only it will be transferred. So with this, we have completed what? We have completed the discussion regarding financial liability, for compound instrument, financial asset. Then we started a discussion regarding small topics, that is of derecognition of financial asset. When do we derecognize financial instruments? Under financial asset, a financial asset should be derecognized when conditions are satisfied. The first condition is that the contractual right to receive the cash flow have been expired. That means now you do not have any right to receive the cash. And financial asset has been sold, and substantially all the risk and reward should be transferred. Risk and reward should be transferred. If the risk and rewards are not transferred, it will not be a sale transaction. Accounting treatment, what should we do, sir? The difference between the carrying amount and the amount which you receive will be your difference, and that will be a gain or loss. It should be recorded in P&L. So which category? Operating or investing category? Operating category for receivables, all these items. Investing, if you have invested in loan notes, debentures, bonds, it will go that nature of the financial asset. So then we had seen the accounting here. We had seen a factoring which is regularly tested in MCQ or in single entity without recourse and with recourse. So we had taken an example R limited and B limited. If B limited come back, if B limited can come back, this will not be a sale. If B limited is coming back to R limited to collect the money, then there is no sale. Then it's not a genuine sale. So what we will do? This is with recourse. With recourse means when you're factoring or when you're selling your financial assets, the person is coming back to you to get the amount if the third party is not paying them. If B is not coming to R to collect the amount, then it is without recourse. In without recourse, what we'll be doing? We will see the accounting treatment. So without recourse and with recourse. So without recourse is a genuine sale of asset. It means all risk and rewards relating to financial asset has been transferred. So with recourse, I mentioned that B will be coming back. So in that sale, it is not a genuine sale. But without recourse, they are not coming back, then it is a genuine sale. In that case, the factoring fees will be very high. Derecognize the financial asset, difference will be recorded in the P&L, carrying amount and the proceeds. So we have taken an example, 20,000, you received 80,000. So it is a sale. So sale means debit what comes in credit, financial liability you remove it, and credit factoring charges directly into the P&L or the commission which they are taking. Then with recourse, it's not a genuine sale because the risk and rewards are not transferred. Factoring fees will be low, and do not derecognize the asset. Instead, whatever amount we have received, we should record this as a financial liability alone. So record financial cost to each reporting date. You have to record that cost like your financial liability as per the FI. Then example, we have taken 20,000, 90,000. We record this as a financial liability, and this will be treated normally. So this was the case which we had done for, and we had done 1, 2, 3 questions we had done, and we had taken a lot of examples also. Then we started a discussion regarding financial liability. In financial liability, what did I mention? Financial liability will be derecognized when the obligation is discharged or cancelled or expired. Accounting treatment, carrying amount minus the amount, gain or loss can happen. Operating or financing category based on the nature of financial liability. Based on the nature. Then we started a discussion regarding offsetting financial assets and financial liability. Offsetting financial assets, financial liability. Can we offset the receivable and payable from a single party? Yes, sir. When has a legal enforceable right to set off the amount, they have a legal enforceable right to do it, and intends either to settle on a net basis, either the intention is to settle on net basis. We had taken an example here, if you remember, A and B example. These were the examples which we had taken, that whether they can settle or not. And the second one was what? Or to realize the asset and settle the liability simultaneously. As you give me, I will give you back. As you give me, I will give you back. That is also known as your offsetting. And we discuss a treasury share. Treasury share means what? The company will purchase their shares back from the market at a price higher only or at the market value. So why? Either they can cancel the shares or either they can reissue in future at a higher value. So we had seen an example that if the shares are cancelled, you will have a gain or loss. It will go to retained earning. And if it is not cancelled or it is with the company, then the value will be reduced. The equity value will be reduced. You will show treasury shares and you will reduce the value there of the equity and share premium, and separately treasury shares will be shown. So with this, we have completed our discussion regarding your financial instrument IAS 32, IFRS 7 and IFRS 9. I hope you liked the video. If you like the video, please do subscribe my channel and please do share this video with your friends. Signing off. Bye bye. Have a good day. Radhe Radhe.